A military conflict involving Iran is sending shockwaves through the global economy, and the effects are already showing up in energy prices, inflation expectations, and the outlook for growth worldwide. This is not the first time a war near major oil-producing territory has rattled markets. History shows these conflicts rank among the most disruptive forces the global economy can face. This one is following that pattern. Here is why Iran sits at the center of it. The country is one of the world's significant crude oil producers. More importantly, the Strait of Hormuz, a narrow waterway at Iran's doorstep, carries roughly 1/5 of the world's oil supply. Even the threat of disruption to that corridor tends to push oil prices sharply higher. Actual conflict raises that risk considerably. Rising oil prices act like a tax on everyone. Households pay more for fuel and heating. Businesses pay more to move goods. Those costs feed into manufactured products and food prices, meaning inflation can spread well beyond the gas pump. That creates a serious problem for central banks. Policymakers in the United States and Europe had been cautiously moving toward lower interest rates after years of battling post-pandemic inflation. A fresh energy price shock can reverse that progress. Central banks may have to hold rates higher for longer, or even consider raising them again, to stop rising fuel costs from spreading into a broader inflation problem across the economy. Growth is also at risk. Higher energy costs squeeze corporate profit margins and consumer spending at the same time, a damaging combination. Emerging market economies that import large amounts of oil are especially exposed. They face the added burden of a stronger US dollar, which typically rises during periods of global uncertainty. A stronger dollar makes dollar-denominated debts more expensive to repay, straining government finances in developing nations. Financial markets are already reflecting the uncertainty. Oil futures have moved higher. Equity markets in energy-importing countries have come under pressure. Investors have moved towards safer assets, US Treasury bonds and gold, which is the classic pattern when geopolitical risk rises sharply. Supply chains are also feeling the strain. Shipping routes through the Middle East were already navigating the aftermath of years of disruption. Renewed conflict adds another layer of risk to global trade flows. How severe the long-term damage turns out to be depends on three things: how long the conflict lasts, whether it widens to involve other regional powers, and how quickly global energy markets can find alternative supply routes or tap additional production. None of those questions have clear answers yet. Watch oil market pricing, central bank communications, and any diplomatic signals closely. They will be the earliest indicators of how contained or prolonged this situation becomes. This briefing is brought to you by First Financial News. Clear daily coverage of the economy and markets at firstfinancialnews.com.